Hey everybody, welcome back to the channel. I'm Doug, the Retirement Guy, and today we're breaking down NEOS BTCI. Now, when we look at this and we say NEOS, whoa man, they got SPYI, QQQI, probably some very, very strong packages in our retirement portfolios. And a lot of people talk about, and I've seen a lot of YouTube videos on this as well. Oh my God, BTCI, big payments, big outlay. Well, they advertise a 40% yield. So I really had to ask myself, is this a 40% yield trap? Or is this a good investment for retirees? Well, we're going to break it all down. We're going to find out, is this a risk to a reward, or is this an opportunity that's got a lot of risk to it? We're going to play both sides of the fence, okay? We're really going to have to play how we want to do this. So grab your mug, sit back, pour in your favorite beverage, and let's see which fun this one is going to turn out to be. Important disclaimer, this content is for educational and entertainment purposes only. This is not financial advice. Past performances do not guarantee future results. Hey, if you don't have one of our favorite mugs, the Retirement Made Easy, simple and easy to do. Use the QR code, use the link down at the bottom. You'll see everything that we offer. We got coffee cups, we got travel mugs, we got license plates. All of this, and the reason why we do this is to support the channel. Because it does take some money, it does take a lot of time to produce these videos and the screens that we do. And this just helps push us over the edge to keep things rolling. Now, these coffee mugs, we ship them out immediately out for you. It just helps supports the channel. We are an unbiased channel. We have no advertisers. We have no supporters. We actually have turned down more people than most people would say, just take it and do it. I refuse to do that. So this is one way to support the channel. If you have, thank you so much. If you're not, great opportunity. We also have Patreon that you can do as well. So defining the 40% yield question, sustainability and distribution rate and total returns are all different kinds of scenarios. You can have that big 40% distribution number, but if you don't have a strong total return number, it doesn't mean anything. If you have a strategy that just can't keep producing that distribution rate and you end up giving your own money back, that's not really a true answer either. So what we do here is the investment based on a $100,000 investment at the trailing distribution rate right now, which as of the end of June 30th, and I only do that because that closes out the entire month, and I can use everything from it. If they tell us what the ROC is going to be, they tell us everything about it. You're at 41.33%. So basically, you're making about $41,000 over the past trailing distributions. But the retirement reality check is this. How does BTCI produce monthly cash flow from Bitcoin? Is 40% distribution sustainable for long term? What is the impact of the NAV, the net asset value? Are these payments classified as income or return of capital? And does this belong in a near or a core piece of a retirement portfolio? Well, we're going to talk about all of that today, especially my golden rule. Yield is only a math number. And what I mean by that is if the price of the stocks go up today, your yield's going to go down. And if the stock prices goes down, your yield is going to go up. It's just that simple. Nothing changed other than the price of the fund. But total return tells us whether the investment is actually working or not working. So first, let's break down what is BTCI. When it comes from NEOS, NEOS has got a very good history. They got a good working group that does a lot of stuff with it. This is an active managed fund. The objective is high monthly income plus potential price appreciation. The exposure to Bitcoin ETPs and their complex derivatives. This thing launched in October of 2024. So we're really over almost 2 years into this to target the crypto volatility. Now the cost profile, this is a 0.99%. Now all the numbers I show you will always have this invested into it, but why I show you this and why the expense report to me is important is if you're going to put this in a retirement, you're probably going to hold it for a long periods of time. That means you're basically paying about 1%, okay, of your investment is going into operating expenses. So right off the top, 1% is going to NEOS. And then if you have a financial advisor, probably another 1% is going to them. And you just see how a lot of people eat off the top before you get your lunch. So this includes a 0.98 management fee and acquisition fund costs. So it's an expensive fund to hold. Now the fund has $1.1 billion as of July of 24. There's no private wallet. It's held through regulated ETPs. It uses a Cayman subsidiary for tax exposure. And it's a significant sale that reflects high retail investors' interests. So right off the bat, yes, it has a huge net assets, has a high expense ratio, and it does have an active management because it's a complicated mix. Now, there's three parts to Bitcoin's income engine. There's what we call the spot Bitcoin ETPs. These are direct exposures via institutional trusts like IBT, iShares, and HODL, VanEck. Okay, their Cayman Island subsidiary, now it sounds like we're doing money laundering here, but hold tight. The subsidiary usage to optimize regulatory investment company, ROC, tax requirements. The core price targeting mechanism for the fund's underlying asset value. Okay, so these guys are doing the institutional trusts from iShares and VanEck. They're holding it in a Cayman's Island to basically because of the tax requirements needed. Now they do a synthetic long calls. Okay, so these are combination strategy of calls and put options. So if you know, calls are when the things are going up, puts are when the things are coming down. It targets the same reference instrument as strike price and expiration date. It captures the upside while retaining significant downside exposure of Bitcoin. And then the covered call writing. It sells call options on Bitcoin-linked instruments to harvest that volatility. Okay, the option premiums generate that premium source of monthly distributions, and it trades future capital appreciation for immediate current income. So as we all know, when they're selling call options, you cap your growth, so it can only go up so much. That's what makes it so scary with call options, is that if it caps the top and the market takes off, you're going to miss that mark. And here's the other one. If it goes way down, for it to come back up, it's going to take you forever to get yourself out of the negative zone. The option premium is not a safety net. Converting Bitcoin's volatility into income versus capital protection. This is a dual rise. The ideal scenario allows for a steady premium collection while maintaining some participation in Bitcoin's price appreciation. But the explosive rally, selling calls exchanges the future's upside for the current cash. And then market crash. Premiums provide a potential cushion, but not a floor. Okay, they rarely offset the full magnitude of a sharp Bitcoin drawdown, and that's what we've seen. We have not really seen much rallies in Bitcoin. We've really seen a drawback on Bitcoin. So this thing is, again, it's protecting itself in market crashes. It's not gaining, but it is making income from selling the call options. The NEOS strategy reality, BTCI converts Bitcoin volatility into distributions. This is a fundamental different from a traditional dividend ETF fund. NEOS warns that the strategy has limited gains and premiums may offset losses under the exposure. So very, very critical, very hard piece to really fit in. And not to explain, but to understand that they're selling options on Bitcoin. Okay? They're also selling and exchange futures. So really they're doing everything to drive income on these funds. Now decoding the distribution metrics. So I'm using June 30th, as I told you earlier. I always like to use the closed out month. That way we have hardcore, I can go through it and say hardcore, full audited pricing across the board. So in the trailing 12 months, the fund has collected 41.33% of income yield. The current annualized number is coming at 26.16%. Okay, that is the most recent monthly payment into a full year. So you can see things have dropped off. 30-day SEC yield, 2.13. Now, why is that number important? Because that's what's actually interest. If there's dividends or any other money that they can record versus cover call premiums, they can record. So some of the money is actually coming from money sitting on the sidelines and holding accordingly. But the massive spread between that 41.33 trailing rate and that 2.13 SEC yield confirms that the vast majority of the cash is paid is not traditional income. The SEC yield measures the net interest and dividends, standardizing for comparison. So what basically we're saying here is over 38% of this yield has to come from those options trading. Okay. Now, this is the big one. The 56% pay cut. Can the high yield be trusted? In July of 2025, the payout was $1.47 per share. A year later, they're down to 64.5 cents. That's a 56% reduction in distribution rates. While the 12 months remains high at 41%, the actual dollar distributions have plummeted, using the July payment of 65 cents. In July, the NAV was at $28.42. So the current annualized rate is approximately 27.3%. So what I'm saying here is your 41% is using last year's numbers when things were doing good. Moving forward at this new rate, you're really looking at a 27% yield. So the question is, can this number be trusted? And the answer is no. So the trailing distribution rate is a reflective of the past, not a promise of your future budget. This is why I say past performances don't always guarantee future results. This is the prime example of that story. Let's take a look at the dividends a little deeper. Okay. Currently, right now, if you look at stock analysis or anyone like that, they'll show you a yield of 40.66%. And remember, guys, that yield number will change. If the price goes down or the price goes up, that yield changes. That's just a number. Your annual distributions, $11.54, paid out monthly. So we look at the chart up above. Look at the numbers. And you can see in January of 25, I'm all the way out to July 26, and it's just a steady, fairly decline in dividend payments. So BTCI is losing its payout value. Okay, they're not paying out as much as they once did, and they're dialing back down to a smaller number. Now, here's the next thing I start looking at, the dividend yield. Now, how do you look at that? Why do you look at that? Well, remember I told you that's a math number. And what is happening with the yield itself? And as the yield comes down or the yield goes up, as I already explained to you, the yield goes up, the price of the fund is going down. So when you see this in January 26, it rocketed, basically about February, it rocketed up to almost a 50% yield. It's because the price went down. Your yield didn't go up. They didn't pay more. Let's take a look at February of 26 is when they started their decline in their dividends. So this is the fund that looks great on paper, 40%, but the yield is only up that high because the price has come down so low and the dividends are now following it equally. Now the NAV analysis, this is the next thing. And I really did this differently than a lot of other videos that we've done because I want to show you exactly when you say NAV erosion. This is the picture of NAV erosion. This is what people don't, they try to say a price drop today is NAV erosion. Well, this is the true NAV erosion. When this thing came out October 24th, it was $50 a share. The current NAV of the close of business on July 24th was down to $28.42. That's a 43.16% decline. Now, so many people I watch out there on different videos will say, buy, buy, buy. This is the future is all this. Well, have we hit bottom? Are we at the rock bottom? Because we still have room to drop. Okay? This has room to get smaller. So the erosion passed, the X distribution effect. High monthly payouts naturally reduce the NAV dollar for dollar on the X date. The market headwinds, the 43% drop, includes actual Bitcoin ETF losses and the cost of those synthetic exposures. And the historical volatility, the NAV peaked at $58.95 back in May of 2025 before beginning that downward trajectory. So the shrinking asset base, a smaller NAV means the fund has less capital to harvest for future option premiums, which is why you're seeing the dividends even beginning to drop off. The dollar yield pressure supporting that $1.47 payout is significantly harder at a $28 NAV than a $50 NAV. And the downward spiral, the decline of the NAV often leads to declining dollar distributions, even if the percentage yields remain high. My viewers, you out there, understand that one probably, hopefully the best across the board, and that is the declining NAV often leads to declining dollar distributions, even if the percentage yield remains high. You should be able to say, yes, you got a 40% yield, but your NAV is dropping, you're losing value, and it's not a true number. The ultimate performance metric is total return. Okay? This is, again, teaching everyone where we're at today. So that $10,000 case study, the true economic value of that $10,000 invested held for 1 year, assumed that all distributions were reinvested, which is what we normally call dripping. Your $10,000 invested into this 1 year ago means you had $5,905. You didn't get 40% income. You didn't get anything. You basically gave them $10,000 and they say you now have virtually $5,900 left. What would you like to do? You're giving your money away. Total return year to date, this thing is down negative 30.1%. So there is no yield. There is nothing out there. Don't tell me about a 40%er. Don't tell me anything about it. You have actually lost 30% value in your fund. 1 year, you're down 40.95%. So the answer to this whole thing is you are not gaining any money on BTCI. So when we take a look at the relationship between BTCI and Bitcoin, well, BTCI is not doing, I'm going to call it, as bad. They're doing as bad as Bitcoin. When we see year to date, Bitcoin's down 32.93%, you're down 30.1%. You're doing 40.95%, Bitcoin's down 45%. Since inception, Bitcoin's down 13, you're down 12. So the answer to it, guys, is there is no downward, there's no protection from being down. It is relatively down each and every year. Okay. So this is where we have to test for the destructive NAV erosion. And this one is truly a NAV erosion piece. Initial growth phase, when this thing came out, like we said earlier, May 25th, when this thing really hit its peak, $58.95, that was a total return of 43.24%. This was probably everyone sitting there saying, winner, winner, chicken dinner, we got the best thing going, let it go. At that point, when it's turned all the way from May to December, the erosion phase was in heavy bloom, down 43.97% for a total return negative 12.50%. That means all those distributions that you got are ROC. That means you're getting your own money back. And unfortunately, this is really a yield trap. Put it out there. I'll be man enough to stand up here and argue with anybody. This is the hardcore yield trap. Repeated price declines, declining distributions, and total return failure. It matches each and every one of these categories. All three boxes are checked. That means you have yourself a yield trap without even blinking an eye. Now we get into taxes. This is what's really sad. And this is what really, I'm just going to tell you, hurts people to no end. Okay. July of 2026, the estimates that they were looking at already was 92% return of capital. 92% of those distributions coming to you was return of capital. And unfortunately, even with NEOS, that means it was actually true hardcore return of capital. Okay. The fiscal year right now, their trailing is about 93. January to May of 2025, they were using 91%. June to December of 25, they reduced it down to 44%. The answer is these guys are using your return of capital to keep the fund afloat, to keep it promoting. The asset location and risk control. The reason why I say this is what I hate so much about this is you're getting your money back and you're paying taxes on your money. You're going to end up paying taxes on your own money again. Because when it comes back to you as your own money coming back, that's income down the road that we're going to look at. A taxable account, the ROC may defer your tax. It's not free tax, it's deferring it down the road. Okay? In traditional IRAs, it avoids the annual tax because you're in the IRA. It's going to wait till you pull money out. Problem is you're not going to have any money to pull out. Same thing with a Roth. Hey guys, don't forget about our travel mugs. I know it's another plug, but all of this supports the channel. You see how much hard work we put into these videos to give you what you need. I love this travel mug. If you didn't hear the story before, but I went out to my truck with my coffee mug, hit something, dropped it on the ground, shattered all the way through. And I said, well, this is crazy. Ended up ordering travel mugs, and they've been hit a big hit. So don't forget about the travel mugs. You can always get those. Use the QR code or hit the link down below. So retirement role and the performance scorecard. Well, I'm going to start off on the left-hand side. The core retirement holding, this is a positive no. There's no way in the world that this should be in your retirement account. I don't care what anyone else says. I don't care if you see another video that says I made $1,000 this week alone or this month or $5,000. They're not making it. They're not making true hardcore numbers. As a satellite, not even close. I'm not even willing to even put you in the category of that. There is no safety. There is no cash reserve bucket. There is no retirement paycheck. There is nothing to it. This is not a piece to invest into. The performance scorecard. I'm going to give it a 9 out of 10 for that potential income, which realistically, I kind of showed you all that there really is no income. It's your own money coming back to you. So the income reliability is almost nothing, down to a 3. The growth potential, if Bitcoin turned around, there could be some growth to this, but it's capped. So it's going to take a long time to grow back up to that $58 price point as low as we are now. Principal stability, 0, down to another 2. Total return, a 4. Tax efficiency, honestly, even though with the NEOS, it's a 6. And this, guys, this is just a bottom line. This is not a core piece. So the final verdict, I know you guys, I hate being negative. I hate being this down on a fund or anything like this, but the bottom line is this fund is a biggest yield trap I've ever seen. They can advertise the 41.33% trailing yield. The total return tells you the real story. You're down 40.95%. So how does that numbers jive? It doesn't. Your year over year distribution change is down 56%. So we did the deal. We did the yield trap. We did the test, and we came back to you and gave you the hardcore numbers. NAV erosion is happening on a regular basis. Income is decaying, and the total return is not in positive numbers. So yield tells you how much money you're going to have left of the fund. Total return tells you whether you're actually making money. And this one here, you're losing money. Let me know your comments below. I know some of you probably own this. You're probably upset with the comments that I put to it. But Facts are the facts, and that's why we're unbiased, and that's why we sell coffee mugs to help keep the channel rolling, because we want to be able to be honest and straightforward with everyone. Let us know in the comments below. Hit that like button if you like what we're doing. And make sure you're not investing this into your retirement account. That's Doug's opinion. Take it for what it's worth.